Liquidity sweeps happen every single day in the market, but most traders still confuse them with simple liquidity grabs, stop hunts, or genuine breakouts. And that mistake can cost you. A real liquidity sweep can reveal where smart money is entering the market, where a reversal is likely to begin, and where some of the cleanest high-probability setups can form. In this video, I'll show you how to identify real liquidity sweeps, filter out the fake ones, and use confirmations like displacement, CISD, internal liquidity grabs, and lower time frame entry. Welcome back, traders. So, let's get started. A liquidity sweep is all about one thing. Price takes liquidity above or below a key level, quickly closes back inside the range, and then moves toward liquidity on the opposite side. For example, if price sweeps key buy-side liquidity, we expect it to reverse and move towards sell-side liquidity at the opposing level. This is one of my favorite liquidity patterns, because these setups appear almost every day and can help you align with institutional order flow. But here's the important part. Not every move through liquidity is a liquidity sweep. Many traders confuse liquidity sweeps with liquidity grabs, stop hunts, and genuine breakouts. They see price move above a high or below a low and immediately call it a sweep. But while these patterns may look similar, they behave very differently. So before we go deeper into liquidity sweeps and how to trade them, let's quickly break down these concepts one by one. Starting with the liquidity grab. A liquidity grab is usually a small move beyond an obvious internal liquidity level. Price briefly pushes above a previous high or below a previous low, triggers nearby orders, and then reacts quickly. These moves are often shallow and do not travel far beyond the liquidity level. You will see them more frequently on lower time frames, especially during active trading sessions. The key point is that a liquidity grab does not always lead to a major reversal. It usually happens around internal swing highs or lows inside a trading range, where price is simply clearing nearby retail stops. That is why treating every liquidity grab as a major reversal setup can lead to low probability trades. Now, let's move to the stop hunt. This is one of the most misunderstood concepts in trading. Many traders believe a stop hunt means the market is being manipulated, but that is not necessarily the case. A stop hunt is simply a move that triggers a large cluster of stop-loss orders, giving the market access to liquidity and helping fuel the next move. You will often see this happen above equal highs or below equal lows, especially before price taps into an unmitigated supply or demand zone and continues in its intended direction. A real liquidity sweep, however, usually happens at a key external liquidity level, not just any internal high or low. It often appears around important areas such as major higher time frame highs or lows, previous session highs and lows, or around key trading session opens. So, to identify a valid liquidity sweep, we want to see three things. Price takes a key external liquidity level, it happens during a meaningful time window, and price immediately reacts with strong displacement in the opposite direction. Without these three elements, what looks like a sweep can easily become a trap. Finally, we have the genuine breakout. This is where many traders get trapped. Sometimes price takes liquidity, makes a temporary retracement, and instead of reversing, it continues in the same direction with strong momentum. That is why blindly treating every sweep of a key level as a reversal signal is a losing strategy. Sometimes the breakout is the real move, and your job is to know the difference. Now that you understand what a real liquidity sweep looks like, there is another important factor to consider. When does the sweep happen? A sweep that happens at a random time of the day does not carry the same weight as one that happens around a major session open. Liquidity often builds during quieter periods. Then, when volume and volatility enter the market, price moves toward those liquidity pools, takes the resting orders, and begins the next expansion. That is why some of the most important sweeps happen around the London and New York sessions. For example, here price makes a false push higher right around the session open, sweeping the liquidity above the London high. Immediately after taking that buy-side liquidity, price sharply reverses and moves toward the Asia low. So in this sequence, price clears liquidity on both sides before delivering the real move. We can see the same behavior around the New York Open. Price pushes above the London high, sweeps the buy-side liquidity, and then shifts toward the next key sell-side target at the London low. From there, the market begins its true expansion. But remember, time is only a filter, not a confirmation. A sweep happening at the right time gives us context, but we still need price action to confirm that the liquidity event actually caused a meaningful reaction. And this brings us to one of the most important confirmations: displacement after the sweep. Once liquidity is taken, do not enter the market immediately. Instead, watch how price reacts after the sweep. A high-quality liquidity sweep is often followed by a strong and decisive move away from the liquidity level. This is what we call displacement. For example, imagine price moves above a previous low and takes the sell-side liquidity. If price simply stays above that level, moves sideways, or slowly drifts lower, we do not have enough evidence that buyers have taken control. But if price sweeps the low and then aggressively moves higher with strong bearish candles, that is a completely different signal. That displacement tells us that market conditions have shifted and that institutional money may be entering in the opposite direction. And that is exactly the type of confirmation we are looking for. Now you might ask, how much displacement is enough to consider a liquidity sweep valid? The answer is simple. You can use concepts like change in the state of delivery, or CISD, to make the confirmation more mechanical and rule-based. CISD is confirmed when price closes beyond the origin of the candle sequence that led into the liquidity sweep. In a bearish reversal scenario, after price sweeps buy-side liquidity, CISD occurs when price closes below the body of the first bullish candle in the sequence that pushed price into the sweep. In a bullish reversal scenario, after price sweeps sell-side liquidity, CISD occurs when price closes above the origin of the bearish candle sequence that led into the sweep. Adding this confirmation to your checklist can help filter out early entries from fair value gaps or inversion fair value gaps formed inside the sweep leg. This is important because price can still move deeper into a higher time frame zone, rebalance more inefficiencies, or even create another sweep before the real reversal begins. That is what makes CISD powerful. If you want to be more conservative and only take liquidity sweep setups with stronger confirmation, you can add one more step to your checklist. After price sweeps a major liquidity level, do not enter immediately. Wait for price to also clear the internal liquidity created after that first sweep. In other words, wait for a liquidity grab inside the reversal structure. In a bullish setup, price may sweep a major low, bounce, attract early buyers, create internal lows, and then return to sweep those lows before the real reversal begins. The same applies in a bearish setup. Price may sweep a major high, pull back, attract early sellers, create internal highs, and then clear those highs before moving lower. This is important because smart money does not always reverse immediately after taking higher time frame liquidity. In many cases, price first clears the major external liquidity, then removes the newly created internal liquidity, and only after that begins the true reversal. So now, both layers of liquidity have been cleared. First, the external liquidity above or below a major higher time frame level, such as a session high or low. Second, the internal liquidity created by early traders on the lower time frame. This gives the setup much stronger confirmation. Once that confirmation appears, you can look for an entry from a fair value gap, order block, or another valid PD array inside the displacement leg. That is what turns a basic liquidity sweep into a much higher probability smart money setup. Now, let's break down the mechanical rules of the liquidity sweep trading model and see exactly how to execute it. To trade this setup properly, the first step is to define a previous session high and low on the 15-minute chart. The reason is simple. When a new session begins, price often targets the liquidity resting above or below the major swings of the previous session. For example, if you are trading the London session, mark the Asian session high and low as your key liquidity range. Then wait for London to open and monitor price closely. If price sweeps one side of that range and quickly closes back inside, that becomes our first layer of confirmation. From there, move down to the 5-minute or 1-minute chart and look for evidence that the sweep is actually causing a reversal. We want to see strong displacement in the opposite direction, ideally creating a CISD and a market structure shift. This tells us that institutional order flow may be entering the market. Once those conditions are met, we can look for our entry model. If I am using the 1-minute chart, I often look for an inversion fair value gap. This forms when a fair value gap is violated and then flips into the opposite role. In a bearish setup, the newly formed IFVG can act as resistance. So once the IFVG is confirmed, we wait for price to retrace into it and place a sell limit order at the lower boundary of the zone. For take profit, you can target the nearest key sell-side liquidity, the Asian session midpoint, or the Asian low. You can also use a fixed target such as 2.5 or 3R depending on your trading style. If the first position is already running in profit, and there is still enough room for price to continue lower, we can also look for a continuation entry. This often appears when price creates a fresh bearish fair value gap during a pullback after the new bearish structure is confirmed. In that case, the next unmitigated bearish fair value gap can be used as a second entry, with the stop loss placed a few pips above the most recent swing high. That's it, traders. Thanks for watching. I hope you found this video valuable. If you did, hit subscribe and turn on notifications so you never miss an update. Drop a comment below with your thoughts or topics you'd like to see next. Your support means the world to us. See you in the next video.